We have this incredible, almost collective illusion about the digital world. Like we call it the cloud, right? And we talk about software and algorithms and AI as if they're just, I don't know, these weightless, invisible entities just floating around in the ether.
Yeah, it's a very comforting metaphor for most people. It makes the entire digital ecosystem feel frictionless, like it's infinite and completely detached from the messy realities of the physical world.
Exactly. But looking through this massive stack of sources we've gathered for today's deep dive, I mean, we're talking highly technical earnings reports, geopolitical risk assessments, industry white papers. It becomes immediately clear that the reality of the cloud is, well, it's unimaginably heavy.
Oh, absolutely. It's grounded in these incredibly massive, hyper-sterile physical factories, drawing down literally gigawatts of power to forge silicon at the atomic level.
Right. And the single company that basically holds the keys to those factories just dropped their first quarter earnings for 2026.
And the numbers are just staggering. I mean, we are witnessing a pivotal structural moment, not just for one specific manufacturer, but really for the entire trajectory of the global economy.
Okay, let's unpack this, because today our deep dive is entirely focused on Taiwan Semiconductor Manufacturing Company.
Better known as TSMC.
Right, TSMC.
Okay.
And our mission today is to break down their record-smashing Q1 results and explore the literal atomic-scale wars for chip supremacy happening right now.
Yeah, at the 2-nanometer level.
And then we're going to pull back and examine the real-world geographical threats that could bring this entire AI boom to a grinding halt. Because whether you're actively managing a tech portfolio or building large language models or, I mean, just listen to this on a smartphone, right?
Yeah.
TSMC's physical manufacturing capabilities are dictating the speed of your digital future.
They really are. And, to truly grasp the stakes of this conversation, we have to start with the hard numbers.
Let's hear them.
Because the sheer mind-boggling scale of the financial reality TSMC just reported, it completely redefines our baseline for industrial growth. Like in the first quarter of 2026, their revenue hit $35.9 billion US.
Yeah.
Yeah. That represents a 40.6% increase year over year.
I mean, for a company that's already operating at $1 trillion scale, compounding at 40% is just almost unheard of.
It really is.
And their net income came in at over 572 billion new Taiwan dollars, which translates to an earnings per share of 22.08. But diving into the balance sheet, the figure that fundamentally breaks my brain is their gross margin. They reported a 66.2% gross margin.
Yeah, that's the real standout metric.
Right, because if you're manufacturing cars or airplanes or refrigerators, you're absolutely thrilled with a fraction of that. So how does a company doing heavy physical industrial manufacturing achieve the profit margins of, like, a luxury software brand?
Well, it speaks entirely to their pricing power, and the incredible moat they've built around their capabilities. They are operating in a league of their own at the bleeding edge of physics.
Yeah.
And because of these results, the market has rewarded them with a valuation surging to a $1.67 trillion market cap. And what's fascinating here is the most revealing metric in this entire stack of earnings documents isn't the top-line revenue.
It's the composition of that revenue.
Exactly. It's the complete structural pivot in the underlying engine of the semiconductor industry. Because for the last decade, the narrative was driven almost entirely by the consumer, right? It was all about the smartphone supercycle.
Like the expectation that hundreds of millions of people would just reliably upgrade the computer in their pocket every 24 months.
Right. But that era is definitively over. Smartphone revenue now only accounts for 26% of TSMC's total pie. And it actually decreased by 11% this quarter.
Oh, wow. So it's the new driver.
The new monarch is high-performance computing, or HPC. This segment now commands 61% of their total revenue. And get this, it grew by an astonishing 20% in just a single quarter.
That is insane. And just to clarify for the listener, when we say high-performance computing, we aren't talking about a faster laptop.
No, definitely not.
We're talking about the foundational infrastructure for artificial intelligence, like the massive football field-sized data centers filled with tensor core GPUs required to train and run complex neural networks.
Exactly. AI infrastructure has completely consumed the semiconductor sector. Wow. And the technology doing this heavy lifting is microscopic, but it dominates the balance sheet.
Right.
Management noted that their advanced technologies, which they define strictly as the 7-nanometer node and everything smaller, now make up 74% of their total wafer revenue.
Which brings up a really vital dynamic, because we always hear that tired analogy about selling picks and shovels during a gold rush, right? But looking at these numbers, it feels like TSMC isn't just selling picks and shovels. They feel more like the singular, heavily fortified toll booth on the only one-lane highway leading into the gold mine.
That is a perfect way to put it.
Like, if you are Apple or NVIDIA and you need the absolute most advanced AI chips in the world to maintain your market cap, you essentially have no choice but to drive through TSMC's toll booth.
Yeah, the leverage they hold over the global tech ecosystem just cannot be overstated. They have achieved the highest yields and the most reliable advanced manufacturing capacity on the planet. And they charge a massive premium for that access.
But here is where the narrative gets incredibly tense. Because earning nearly $36 billion in a single quarter might suggest they can finally take a breath, right? Like, let the cash accumulate and just service the demand.
You'd think so, yeah.
Instead, the earnings report reveals they are immediately turning around and spending an absolute fortune just to keep the lights on for the broader AI industry.
Right, which brings us to the global capacity crunch. TSMC announced they are pushing their 2026 capital expenditure, their CapEx, to the absolute high end of their previously stated range.
Which was what, 52 to 56 billion?
Exactly. They are maxing it out at $56 billion.
$56 billion in a single calendar year, just on building new physical fabrication plants and equipping them.
And we really have to contextualize that number. That $56 billion comes immediately after spending a combined $101 billion over the previous 3 years.
It's just staggering amounts of capital.
It is. Management was very explicit on the call. Demand is, quote, extremely strong. They're actively breaking ground on 3 brand new 3-nanometer fabs right now.
Right.
And yet, CEO C.C. Wei had to warn investors that supply will remain incredibly tight well into 2027.
See, I have to push back on the underlying logic here. Spending $56 billion in a single year on physical real estate and machinery, doesn't that sound incredibly precarious?
How do you mean?
Well, we've all seen software bubbles inflate and violently burst. What happens if the AI hype cools down?
Ah, the bubble question.
Right, like what if the enterprise software market realizes these large language models aren't generating enough direct ROI, and these tech giants suddenly stop ordering hundreds of thousands of chips? Aren't they terrified of building a $56 billion bridge to nowhere?
It's a fair point, and honestly, it's the single most important risk factor analysts pressed them on during the earnings call.
And what was their defense?
The response requires us to really understand the fundamental bottleneck of advanced manufacturing. The constraint right now isn't a fluctuation in software demand. It's the sheer physical friction of scaling up capacity.
Meaning you can't just spawn a factory overnight.
Exactly. You cannot spin up a semiconductor fab like you spin up a new server instance in the cloud. It takes 2 to 3 years of intense engineering just to build the shell, install the vibration-isolated clean rooms, and bring in the extreme ultraviolet lithography machines.
And those machines themselves cost hundreds of millions of dollars each, right?
Yep. So they're operating on a massive time delay compared to the software industry. Furthermore, they are looking at a deeply entrenched backlog of confirmed, irrevocable orders from major players.
So it's not speculative.
Right. From a financial perspective, management highlighted a crucial ratio. Their revenue growth is comfortably and consistently outpacing their capital expenditure growth.
Okay, so as long as that structural math holds up, the massive spending is structurally justified.
Exactly. They're spending money to unlock confirmed revenue that is currently stuck in a bottleneck, not gambling on future demand.
Okay, so they are aggressively expanding their 3-nanometer capacity to unblock today's needs. But our sources detail a massive, incredibly expensive war already raging for tomorrow's dominance.
Oh, the 2-nanometer supremacy war.
Yeah, and that battle is happening at an even smaller, more unforgiving scale.
It is. And the outcomes here will literally dictate the hierarchy of the tech industry for the next decade.
So let's look at the operational metrics from the report. TSMC's 2-nanometer process, which they designate as N2, actually entered high-volume manufacturing in the fourth quarter of 2025 at their Hsinchu and Kaohsiung sites. And the metric that dictates survival at this scale is yield. TSMC reported their yield is stabilizing between 60% and 70%. Now, we really need to ground this concept of yield for you listeners.
Yeah, it's crucial to understand.
Think of a silicon wafer as a sprawling, hyper-intricate metropolitan city grid mapped onto a delicate disk the size of a dinner plate.
Right.
Manufacturers are using extreme ultraviolet lithography, essentially firing highly focused beams of light to carve billions of microscopic rods and transistors into this city. If a single microscopic dust particle falls on that wafer during the process, it acts like a massive asteroid impacting the middle of your main highway.
It's devastating.
The alignment is destroyed, and the entire chip, which costs a fortune to produce, becomes completely unusable. It's like baking a massive batch of incredibly expensive cookies and having to throw away half the batch because they're burnt. Throwing away half those cookies will literally bankrupt the bakery.
That's a great analogy. The stakes are incredibly high because the input costs are just astronomical. The raw silicon wafers, the massive energy draw required to run the clean rooms, the depreciation on those extreme ultraviolet scanners. All of it means that high yields are the only barrier between a highly profitable manufacturing node and a catastrophic financial black hole.
So if your yield drops too low, you're just burning billions of dollars of raw materials and machine time.
Exactly. Which brings us to the competitors, because the industry reports in our stack show they are really struggling with this physics problem.
Yeah, let's talk about Samsung. Their 2-nanometer yield is reportedly stuck at around 55%. But as we dig deeper into the manufacturing pipeline, it's actually much worse than that headline number implies, right? Let's break down performance binning.
Right, performance binning is a fascinating reality of chip making, because even if a chip technically survives the manufacturing process and isn't destroyed by a defect, it doesn't mean it operates at the required speed.
Right.
Manufacturers test or bin the surviving chips based on their clock speeds and thermal efficiency. The industry reports indicate that when you factor in the chips that fail this performance binning, combined with the inevitable physical losses during final packaging, Samsung's effective yield for final sellable products drops to about 40%.
Meaning they are throwing away 60% of their incredibly expensive city grids.
Yeah.
That is financially devastating. And looking at Intel, the situation isn't much better. Their equivalent 1.8-nanometer process, the 18A node, is reportedly sitting at a 55% to 60% initial mass production yield.
And the courses suggest they won't reach commercially acceptable profitable cost levels until late 2026 or even early 2027.
So TSMC has a comfortable lead. However, it's not a complete monopoly, because Samsung did manage to secure a massive $16.4 billion order for Tesla's next-generation IS6 chips.
True. Which is a huge lifeline and a significant win for Samsung's foundry business. However, the broader context is that Samsung also recently lost crucial high-volume Qualcomm orders back to TSMC.
Why did they lose them?
They lost that business simply because their low yields meant they could not physically guarantee the capacity Qualcomm needed for their launch cycle.
Wow. But I want to push back a bit on TSMC's absolute technological dominance here, because the research notes highlight that Intel has achieved a real structural technical milestone with something called backside power delivery.
Yeah, it's a big deal.
And Intel is fully integrating this into their 18A node right now, while TSMC explicitly stated they won't be using it in their base 2-nanometer chips. Now, backside power delivery works by essentially rewiring the chip from the bottom, routing the power supply underneath the silicon so the microscopic data pathways on top aren't cluttered. Doesn't that give Intel a massive advantage in speed and heat reduction?
Technologically, yes.
And on top of that, you have Elon Musk announcing his own Terafab initiative to start building custom hardware. Do these two factors threaten the core of TSMC's moat?
It's a great question. The backside power delivery milestone is legitimate. Your breakdown of how it separates power routing from data routing is exactly why it improves efficiency. It's a brilliant piece of engineering by Intel.
Right.
However, the analysis of why TSMC remains unthreatened really comes down to the mechanics of mass manufacturing. TSMC's primary advantage isn't holding every single isolated technical feature, it's their entire ecosystem scale.
So it's not just about having the best tech in a vacuum. It's because TSMC already has Apple and NVIDIA deeply locked into their architecture, meaning they have guaranteed massive cash flow and volume to scale faster.
That volume is the secret weapon. Because they have guaranteed massive shipments from day one, TSMC achieves what manufacturing engineers call the steepest ramp-up slope.
A ramp-up.
Yeah. When you are pushing tens of thousands of wafers through the machines every single month, you get exponentially more data on where the defects are happening. You learn faster, you tweak the lasers faster, and your yields shoot up. That scale drives down the cost per chip and drives up profitability faster than anyone else can manage. Intel, conversely, is mostly running its 18A process for its own internal product lines right now. Less volume means less data, which results in a much flatter, slower ramp-up slope.
So ecosystem scale beats isolated technical advantages every time.
Exactly.
So how did management address the Elon Musk Terafab situation on the call?
Well, CEO C.C. Wei gave a very diplomatic, quietly confident response. He acknowledged the competitors, but pointed directly to advanced packaging. He literally stated, "We supply the largest reticle-size packaging. Our competitors have attractive technology, but we work hard so our customers can have more choices."
Oh, that's a subtle flex.
all.
But let's define reticle size packaging for the listener, because it's crucial for AI. The reticle limit is basically the maximum physical area that a lithography machine can print onto a wafer in a single shot.
Oh, yeah.
But modern AI chips are getting so massive that they are physically hitting that limit. So you can't just print one giant chip anymore. You have to print multiple smaller chiplets and stitch them together with microscopic wiring so they act like one brain.
And TSMC's CoWoS chip-on-wafer-on-substrate packaging technology is the undisputed gold standard for stitching those chiplets together.
Right.
So C.C. Wei is essentially saying, sure, a competitor or a customer might try to fabricate their own raw silicon, but when they need to package it into a functional, massive AI superchip, they will inevitably have to come back to our facilities.
Wow.
Furthermore, TSMC is already aggressively pushing past the 2-nanometer threshold. They detailed their A16 chip, which is an angstrom-level architecture, roughly equivalent to 1.6 nanometers, scheduled for high-volume production in the second half of 2026.
And that's projected to be 8 to 10% faster than their enhanced 2-nanometer node.
Right.
So technologically, financially, and operationally, TSMC looks invincible. But, and this is where the deep dive pivots to the most alarming part of the research stack, all this technical supremacy is physically trapped on an island heavily dependent on the Middle East.
Yeah, this is the real threat.
TSMC's ultimate bottleneck isn't Samsung, and it isn't Intel. It is the physical map of the real world.
If we connect this to the bigger picture, it highlights a profound and terrifying irony. We have TSMC operating in hypersterile clean rooms, manipulating matter at the angstrom level, and angstrom is 1/10 of a nanometer.
Which is just unfathomably small.
It's the absolute pinnacle of precision engineering in human history. Yet that entire operation, and by extension the global AI economy, is totally reliant on brute force, highly vulnerable shipping lanes halfway across the world.
The geopolitical threat matrix outlined in these sources is just stark. On March 4th, 2026, a blockade of the Strait of Hormuz was initiated due to escalating Middle Eastern conflicts. And as a direct result of that specific maritime choke point closing, global helium prices have doubled. And helium isn't just for balloons, right? It is a critical, non-negotiable input for advanced chip manufacturing.
It is the ultimate cooling gas. When you're firing extreme ultraviolet lasers in a vacuum to carve silicon, the heat generated is immense. Helium is used to rapidly dissipate that heat and prevent the entire wafer from just melting.
And nearly a third of the world's supply of this crucial gas comes from Qatar's Ras Laffan facility, which was forced offline after strikes in early March.
It's a huge supply shock.
But the dependency goes far deeper than specialty gases. It comes down to literally keeping the lights on. The island of Taiwan relies on physical imports for 97% of its total energy needs.
97%.
And 37% of its entire power grid runs on liquefied natural gas, or LNG, imported directly from the Middle East.
And the statistic embedded in these reports that should give literally any tech investor or AI developer pause is the buffer. Taiwan currently only possesses 11 days of LNG reserves.
11 days. I read that line in the energy report and had to double-check the citation.
It's wild, isn't it?
We are talking about the company that physically manufactures the foundational hardware for the entire global AI revolution. They are drawing down massive amounts of gigawatts to run these fabs, and they are sitting on an island that is less than 2 weeks away from a total grid collapse if those specific shipping lanes stay blocked.
Yeah.
That is an almost incomprehensible level of vulnerability for the global economy.
It is a razor-thin margin of error against global geopolitics. However, management was forced to address this head-on during the earnings call, and they detailed some extensive mitigation strategies.
Like what?
Well, for specialty chemicals and gases like helium, they do not run a just-in-time inventory system from a single source. They have spent years building a well-diversified global supplier base and maintain heavy safety stock inventory physically on the island to buffer against these exact types of shocks.
Okay, but they can't stockpile gigawatts of electricity. How are they handling the LNG crisis?
They are working in lockstep with Taipower and the Taiwanese government. The government announced they've actively secured sufficient LNG supply from alternative, non-Middle Eastern spot markets to keep the grid fully operational through at least May.
Okay, so that buys them some time.
Yeah, they're aggressively rerouting ships and setting up rolling power backup plans. So, for the near term, TSMC stated they do not expect any material disruption to their operations.
Which is reassuring for this quarter's guidance, but it starkly illuminates the subtext of their massive spending. It really underscores why TSMC is taking a significant portion of that $56 billion capex and aggressively building factories completely outside of Taiwan.
Like their massive $165 billion long-term commitment to fabs in Arizona.
Exactly. They're being forced to geographically diversify to protect the integrity of the global supply chain.
Because the geopolitical reality of the 2020s has dictated that geographical concentration, no matter how highly optimized or economically efficient it is, has become a massive, unacceptable liability.
So what does this all mean? We've unpacked a staggering 40% revenue growth, a $56 billion physical expansion budget, microscopic wars over yield percentages, and the fragile logistics of global shipping blockades. When we synthesize this entire stack of sources, what is the ultimate takeaway from this moment in tech history?
The primary takeaway is a harsh reality check regarding the nature of artificial intelligence. The AI revolution is not an abstract software phenomenon happening in an invisible cloud.
Right.
It is a deeply physical, heavily industrialized reality. It is inextricably tied to TSMC's ability to forge silicon at atomic scales, navigate highly volatile geopolitical minefields for basic energy inputs, and successfully deploy tens of billions of dollars of capital every single year without making a mistake.
Because without TSMC laying the physical tracks and pouring the concrete, the exponential AI software train physically cannot move forward.
They are the ultimate, immovable physical bottleneck for the digital future.
And that leads to a really fascinating and frankly provocative thought to leave you with. As we reviewed the long-term forecasts from industry analysts, a consensus is starting to emerge that TSMC's 2-nanometer and 1.6-nanometer generations might actually have the longest life cycles in the entire history of semiconductor manufacturing.
Yeah, which is contrary to how fast we usually see these cycles move.
Right, and why? Because we are rapidly approaching the absolute uncompromising physical limits of silicon. You literally cannot slice a silicon atom any thinner than nature allows. We are running out of physical space to put these microscopic roads.
Which presents a profound paradox for the next decade of technology.
Exactly. We are looking at a software ecosystem, large language models, autonomous systems, neural networks, that wants to grow exponentially, demanding exponentially more processing power with every iteration. But if the physical hardware that runs that software has literally run out of atomic room to shrink and get more efficient, what happens?
It's the ultimate collision.
What happens to the economics of the AI boom when the unstoppable exponential force of software ambition finally slams into the immovable hard wall of physics? We started this deep dive by talking about the comforting illusion of the weightless cloud. It turns out the future of that cloud depends entirely on how much further human engineering can push the physical limitations of the natural world. Think about that the next time you ask an AI a question or look at your tech portfolio. Until next time, thanks for taking the deep dive with us.